with that, with the drama, or not drama, but the excitement coming back into play, your pick of the week this week is the platform that got a lot of the pushback from the meme stocks, and that's Robinhood, ticker symbol HOOD. What are you seeing? What's the opportunity? Can we still get involved?
You know, Robinhood is an interesting play. It's a brokerage house. It caters to, they've made a very simple user interface. They've gotten some agreements with some of the brokerage houses on how their trades are made so that their commissions are wildly low. And yeah, they're used by a lot of the folks that are amateur traders on Reddit that are partnering with each other. Here's the scoop that I see. I see a potential to go long. In fact, I've personally gone a little bit low. I'm not endorsing that anybody else go long here, but I'm seeing the potential for you to go long and the possibility for us to create a premium trade out of it, but not necessarily. So I call this my hybrid trade. I want to be able to set up a initial trade that is directional in nature, and then if the direction kind of wanes off on the symbol I'm following, instead of just selling it with a traditional directional trade, I would buy it, and then once it topped out, I would sell it. Instead of selling it, I have the option instead to sell premium against it, right? And so that's kind of where I am with Robinhood. I think that right now, in fact, today, I purchased it about 2 or 3 days ago. Um, uh, it's a good long, and you have a choice. You could either be buying the stock, and I would recommend if you want to convert this into a hybrid trade, you have to buy the stock in shares of 100, right? And again, I'm not suggesting anybody do this. I'm just telling you what I did. You buy these in shares of 100 so then you could sell premium because options are sold in lots of 100. So if you're going to sell premium against something, you have to have 100. You have to have a one-to-one connection because selling premium means that you're selling call options, and call options give the buyer, the one who bought your call options, the right to buy your stock, right? At whatever price the strike price of the option is. So you have to have the stock. You have to have something to cover this transaction. So that's one option. The other option you can do is, if we look at the option chain, is to use like this January or this February option. So we're talking about January or February 2025. And you go out that far, and we use an option that's pretty deep in the money, and we call this an option substitute. You can see there's plenty of liquidity on these options that are very deep in the money. I could see using this $10 strike price. It is trading quite aggressively. It's got just a little bit over the amount of extrinsic value in it that I usually like to, but I could go for it. So instead of buying the stock, you could buy contracts of this call option, and it'll behave pretty much like the stock. The stock is trading at $20. This particular option is trading roughly at $10.85. So you get a little bit of a discount, but you also have the same covering position. So I like that potential trade too. I went ahead and bought the stock because I kind of want to have Robinhood in my portfolio for the long term. So whether you buy the call option or you buy the stock, you're now set up as Robinhood appreciates to get, accrue value, get the asset to appreciate. Your position is appreciating. Now, if it continues up, say, well, we could draw our lines and come up with kind of an idea of some criteria. So roughly, if it goes above $22, then I'm going to keep it a directional trade, and I'm just going to, when it loses steam, I'm just going to sell it, right? I'll probably employ what's called a trailing stop loss order to get it to where I exit at as high as I can. However, if instead it loses steam before that $22, then I'm more likely to sell those call options so that I can and I'll sell at the money near term. So near term for me is about 3 weeks out. And the idea here is if Robinhood pulls back from that, then I'll keep that premium and I also get to keep the stock. If it goes above wherever I set that strike price at the time, I'll get cashed out, but I'll get cashed out at whatever profit I am. Plus, I got to get that extra chunk of money for the at the money option. In fact, if we take a look right now at, say, for instance, the May 17th option is expiring right now. So I'm going to look at the June option. If I was to sell the at the money June option right now, I'd be able to get $1.41 a share. And remember, these are in lots of 100. So I get $141, right? That's not chump change. That right there has lowered my cost basis, my break-even price. So I'm really into the hybrid trade on Robinhood, Sip.